In the year 2003, Warren Buffett paid income tax at a rate of 0.1%. That same year, his secretary paid income tax at a rate of 30% on her earnings. This is not a conspiracy theory or a glitch in the system, but the deliberate design of how wealth actually works in America. While you trade hours for dollars and watch taxes vanish from all paycheck, billionaires play an entirely different game with entirely different rules. They are not breaking laws or exploiting temporary loopholes, but leveraging a tax code written specifically to reward the accumulation of capital over labor. The system does not punish them for being rich, but instead rewards them for staying rich. This is the story of how the wealthiest people on earth legally pay less tax than middle-class workers. It is a story about power and policy and the fundamental difference between earning money and owning things. Understanding this system does not require a degree in finance or a background in accounting, but simply the willingness to see. What you are about to learn will change how you view your paycheck and your government forever. Most people believe taxes are straightforward and everyone follows the same basic rules with slight variations based on income. You earn money and the government takes a percentage before you ever see it in your account. The more you earn, the higher percentage you pay, which seems fair on the surface and logically sound. This is called the progressive tax system, where higher earners contribute more to fund society's infrastructure and services. But this logic only applies to one type of income, which is wages or salary earned from labor. The tax code treats income from work very differently than income from wealth, and this distinction is everything. When you work a job, your income is classified as ordinary income, which faces the highest tax rates. Federal income tax brackets for wages can reach up to 37% for top earners in America. State taxes add another layer, and payroll taxes for Social Security and Medicare take another significant chunk out. Before you even receive your paycheck, the government has already taken what it is owed from you. There is no negotiation and no delay, just automatic withholding that happens behind the scenes every 2 weeks. But when wealth generates income, the rules change completely and the tax rates drop dramatically and suddenly. Income from investments like stocks, bonds, and real estate is classified as capital gains, not ordinary income at all. Long-term capital gains, meaning assets held for over a year, are taxed at a maximum rate of 20%. That is already 17 percentage points lower than the top wage tax rate for working Americans everywhere. But billionaires do not stop there because the system offers them tools that wage earners cannot access or use. The first strategy billionaires use is simply not selling their assets, which means not triggering any taxable event. If you own stock that increases in value, you do not owe taxes until you sell it for profit. This is called unrealized gains, and the IRS does not tax unrealized gains under current law anywhere in America. So, billionaires accumulate billions in stock holdings and watch their wealth grow without paying a single dollar. Elon Musk's net worth can increase by $50 billion in a year, but he pays zero tax. Jeff Bezos can see Amazon stocks soar, adding tens of billions to his wealth, but again, zero tax. The wealth exists and it is real, and it can be used, but it remains untaxed indefinitely. You might ask how they pay for anything if they never sell their assets or convert wealth. The answer is, they borrow against their wealth using something called securities-based lending, or buy, borrow, die. Banks will lend billionaires hundreds of millions of dollars using their stock portfolios as collateral for the loan. The interest rates are incredibly low, often under 2%, because the loan is backed by assets. Borrowing money is not considered income, so there is no tax owed on the borrowed funds at all. The billionaire now has cash to spend on mansions, yachts, private jets, and anything they desire without selling. When they die, the assets pass to heirs, and the cost basis resets under step-up rules. The heirs can sell the assets immediately and owe zero capital gains tax because of the reset. The loan is repaid from the estate, and the tax bill never comes due for anyone involved. This cycle repeats across generations, allowing dynastic wealth to grow completely untaxed for decades or even centuries. The second major strategy is using tax deductions that are only accessible to the extremely wealthy individuals. Billionaires often own businesses or invest in real estate, which come with massive deduction opportunities not available. Depreciation allows property owners to deduct the theoretical wear and tear of buildings from their taxable income. Even if the property is increasing in value, you can claim it is losing value for tax. A billionaire can buy a $100 million building and deduct millions annually while the asset appreciates. Business losses can offset other income, which means a bad investment in one area cancels taxes elsewhere. If a billionaire loses money on a startup, they can use that loss to reduce taxes owed. Charitable donations also provide deductions, but billionaires use donor-advised funds to maximize the tax benefit strategically. They donate appreciated stock to a fund and get a deduction for the full market value. They never pay capital gains on the appreciation, and they control when the charity actually receives money. The donation might sit in the fund for years while the billionaire gets the tax break immediately. Private foundations worked similarly, allowing billionaires to fund their own charities and employ family members with salaries. The foundation must donate only 5% of assets annually, leaving 95% to grow tax-free. Foundations can exist forever, creating a tax-advantaged vehicle that also burnishes the billionaire's public reputation and legacy. The third strategy involves shifting income to lower tax jurisdictions, either domestically or internationally, through legal structures. Corporations can establish subsidiaries in states like Delaware or countries like Ireland with favorable tax laws. Profits generated in high tax areas are transferred to low tax areas through licensing fees or loans. Amazon, for example, has used Luxembourg to reduce its tax burden significantly on European revenue streams. Google and Apple have famously used the double Irish with a Dutch sandwich structure to minimize taxes. These are not illegal schemes, but standard practices designed by the world's best tax attorneys and accountants. Individuals can also relocate to states with no income tax like Florida, Texas, or Nevada officially. Many billionaires claim residency in these states even if they spend most of their time elsewhere. Proving residency requires some documentation, but it is far easier than people assume for the wealthy. They maintain a home in Florida, spend a few months there, and register to vote there. This alone can save tens of millions in state taxes annually for a single high-net-worth individual. Trusts and offshore accounts add another layer of complexity that further reduces the billionaire's taxable footprint. A trust can hold assets, and the income generated is taxed at the trust level, not personally. Offshore trusts in places like the Cayman Islands allow wealth to grow with minimal reporting requirements. While tax evasion is illegal, tax avoidance through legal structures is considered smart financial planning by authorities. The line between the two is policed by audits, but the IRS audits wealthy individuals far less. Audit rates for millionaires have dropped significantly over the past 2 decades due to budget cuts. The IRS focuses resources on lower-income earners whose returns are simpler and cheaper to audit. The fourth strategy is timing income to take advantage of years with lower tax rates or obligations. Billionaires can choose when to realize gains by deciding when to sell stock or property. If they expect tax rates to drop in the future, they delay selling until the change. If they have a year with large deductions or losses, they might realize gains to offset. This flexibility is something wage earners do not have because their income is automatic and withheld. You cannot tell your employer to delay your paycheck until next year when tax rates are lower. But billionaires control the timing of nearly all their income streams through strategic asset management and planning. Stock options are another tool that allows billionaires to defer income while building wealth through company equity. Tech executives often take salaries of $1 and receive compensation entirely through stock options instead. Options are not taxed when granted, but only when exercised, which can be years or decades. When exercised, they are often taxed as capital gains, not ordinary income, reducing the rate paid. Retirement accounts available to everyone are maxed out by billionaires, but they use advanced versions of them. A Roth IRA, for example, allows after-tax contributions to grow and be withdrawn completely tax-free. Billionaires have used this by placing startup shares in Roth IRAs when the value is near zero. When the startup becomes worth billions, the entire amount grows tax-free inside the retirement account. Peter Thiel famously turned a $2,000 Roth IRA into $5 billion tax-free. This loophole has been criticized but remains legal under current rules and continues to be exploited. Why does this system exist, and why has it not been changed if it seems so unfair? The answer lies in political power and the way tax policy is shaped in the United States. Wealthy individuals and corporations spend billions lobbying Congress to write tax laws in their favor consistently. Campaign donations flow to politicians who support tax cuts and deductions that benefit the wealthy donor class. Politicians depend on these donations to run expensive campaigns and win elections, so they comply with donor wishes. Tax policy is incredibly complex, which allows loopholes to be buried in thousands of pages of legislation. The average person cannot read or understand the tax code, so they rely on experts to explain. But those experts are often the same accountants and lawyers who design the strategies for billionaires themselves. Public outrage over inequality rises and falls, but sustained political will to change the system never materializes. Proposals to tax wealth directly or close loopholes face immediate opposition from powerful lobbying groups and think tanks. The narrative is framed as punishing success or discouraging investment, which resonates with many Americans culturally. The myth of the self-made billionaire persists even though most wealth is inherited or built using advantages. People believe they might become billionaires one day, so they oppose taxes that would affect the wealthy. This is called the temporarily embarrassed millionaire phenomenon, and it shapes voter behavior significantly in America. Meanwhile, the tax burden has shifted over decades from corporations and wealth to labor and consumption. Corporate tax rates have fallen from 35% to 21% in recent years alone. The wealthy pay a smaller share of total taxes than they did 50 years ago comparatively. Middle-class workers now shoulder a greater proportion of the tax burden than any time since. The impact of this system is not just unfair, but it is economically destabilizing for society long-term. When wealth concentrates at the top and avoids taxation, it reduces funding for public goods and services. Schools, infrastructure, healthcare, and social programs all depend on tax revenue to function and serve citizens. Underfunding these systems creates a downward spiral where the middle class struggles and social mobility declines. Billionaires sending their children to private schools have no incentive to fund public education improvements. The inequality gap widens and resentment grows, creating political instability and social division across the nation. Economic growth suffers because consumer spending drives the economy, and the middle class spends more proportionally. Billionaires cannot spend all their wealth, so it sits in investments rather than circulating through the economy. Tax avoidance also undermines faith in government and the social contract that binds society together fundamentally. If people believe the system is rigged, they lose trust in institutions and democratic processes overall. This creates fertile ground for populism, extremism, and authoritarianism to take root and flourish dangerously. The perception that rules only apply to some people erodes the legitimacy of the entire system. Young people especially feel the system is broken and they have no stake in maintaining it. They see billionaires paying less tax than teachers, nurses, and firefighters, and they lose faith in fairness. This is not a sustainable trajectory for any society that values stability and cohesion long-term. Understanding how billionaires pay less tax than you are, not about envy or resentment, but clarity. The system is not broken, but it is working exactly as designed by those with power. Tax policy reflects priorities, and the current system prioritizes capital over labor and wealth over work. Changing this requires political will, public pressure, and a fundamental rethinking of what fairness means in society. You cannot individually change the tax code, but you can demand accountability from elected officials who write it. You can support candidates who prioritize closing loopholes and taxing wealth more fairly and transparently in legislation. You can educate others about how the system works so they understand the issue beyond misleading soundbites. The first step is awareness, and now you have it. So the question is, what comes next? Will you accept the system as inevitable, or will you push for something different and more equitable? The choice is yours, but the stakes could not be higher for your future and generations. The game is rigged, but only if we allow it to stay that way forever.